In the time that you spent here in Houston, did you ever make it up to the woodlands?
So my main experience with the woodlands was that when I went to undergrad at Texas A&M, from Connecticut, right? I didn't know anybody within 100 miles of the campus. And I showed up, and my main experience with the woodlands was realizing that all the smart kids seemed to have come from this mystical place called the woodlands that I'd never heard of.
Yeah. Well, appreciate it. Yeah. So I went to high school in the woodlands, although we just alienated the people that are listening that did not grow up in the woodlands. I didn't know this, even though I went to high school there, that not only is the woodlands the original master plan community, but that the guy who sparked the Shale Revolution, George Mitchell, was the architect behind it. Do you know that?
I learned it recently. Yeah, this guy was prolific. I mean, sparked the Shale Revolution and is the source for all the master plan communities kind of still being built today.
Legend.
Yep.
Ready to go?
Let's do it.
One day, while supervising the fracking of a well in the Barnett region, Nick Steinsberger noticed that the gel and chemicals that were part of the fracking fluid weren't mixing properly. As a result, the substance being pumped by the crew of the contractor hired for the job was more of a liquid than the thicker jello-like substance normally used to fracture the rock and open its spores so gas could flow. The faulty fluid was more bad luck for George Mitchell and his men. It was just a mistake, Steinsberger says. Steinsberger saw that the well's results were surprisingly good, though. To most of the Mitchell crew, it seemed a fluke. The well was producing a respectable amount of gas despite relying on faulty and watery fracking fluid. Steinsberger didn't necessarily disagree with the conventional wisdom, but the old approach didn't seem to work, and he had to cut costs somehow. He figured it was worth a try to include more water, cut out the gel, and reduce the chemicals. He was just trying to save Mitchell Energy enough money so that his group could live to fight another day. That is an excerpt from a book called The Frackers by Gregory Zuckerman. And spoiler alert, not only are George Mitchell and Mitchell Energy going to live to fight another day, they're going to change the world. And that is not hyperbole, right? They're going to have a massive impact on your life, on my life, everybody listening, by basically unlocking generations worth of cheap energy in the US. And they're going to single-handedly transform global energy markets. So this, Matt, is the first episode of a series that I'm personally really excited about. Listeners may or may not know that you and I rode the wave of the Shale Revolution early in our career, starting with our time at Texas A&M and then across capital markets, high yield bonds, energy M&A, private equity, private credit, actually operating oil and gas wells. In this series, we're going to dive into the Shale Revolution, which in my opinion is probably the most underrated technological revolution in history. And I would argue the Shale Revolution is at least as impactful as the dot-com boom that we just covered in our last series, but it is much less well known, and it's definitely much less well understood. So, in fact, there's a lot of controversy and misunderstanding around fracking, one of the many technologies that unlocked all of this. And underpinning this whole story is the most complex global and fundamental market in the world, the energy markets, and in particular, oil and gas. And in this first episode of the series, we're going to tell the story of George Mitchell and his team, right? People like Nick Steinsberger that we just heard about, and how they solved the real shale problem, which was not, is the gas there, but actually, can it be produced economically? So the story underpins most major issues that we're talking about today too. So it's very relevant. So you've got AI and the bottleneck being power and a core part of that kind of immediate solution being natural gas. Russia, Ukraine, Europe would be completely vulnerable to what's happening in Russia and Ukraine if it weren't for American natural gas. The affordability conversation in the US, the budget and trade deficits, it's hard to find a substantive issue where the shale revolution isn't relevant today.
Yeah, and I think it's to me, it's fascinating that this was happening at the same time as the tech and telecom bubble that we just covered.
That's right.
And so the Nick Steinsberger quote you read in the beginning, that happened in March of 1997, which is the year Amazon went public.
Yeah.
Right? So all of this is happening at the exact same time, and it really happened by mistake, right? That initial discovery was a mistake, and you hit some of the things about how this has changed the world. Just to put a couple numbers on it, right? So in 2000, we were importing 70% of our oil, and now we only import about 10%, and two-thirds of our production comes from shale,
Yep.
which is from this world. In 2000, we were importing 15% of our natural gas. Natural gas demand since then has just boomed, right? It's up about 50% since then, but now we're a net exporter, and 80% of our natural gas production comes from shale, from
Yep.
this thing that Nick Steinsberger discovered by accident in 1997. You mentioned some of like there's huge geopolitical impacts to this that we're not going to touch on as much because this is the story of George Mitchell. My favorite book on the geopolitical impacts is a book called Windfall by Megan O'Sullivan. So I would go read that if you kind of want to understand how this, shifted the tectonic plates of the world. And then last, right, like anything you read about AI right now, it's taken for granted that the supply is there,
Right.
right? Which is wild because it was not long ago that it was not there, and people were freaking out about it. Like if you read about the things people are concerned about in the energy landscape with AI now, it's the concern is around constraints with equipment like turbines, and concerns around like fast enough grid connections, and nobody's concerned about there being enough supply, and that's because of this, right? It's
Exactly.
absolutely because of Nick Steinsberger's discovery in 1997.
Yeah. Yeah.
And so this is a huge deal, and I totally agree. It's been underappreciated for how big of a deal this is.
And it all starts not just with Nick Steinsberger, but with one company well before that mistake leads to a major insight. It's a company in North Texas with a hell of a stubborn founder who refused to accept the conventional wisdom and who, in a lot of ways, was forced into that position by kind of a perfect combination of circumstances. And that founder is George Mitchell. So let's paint a bit of a picture on George first before we dive into the company and into natural gas markets. So George Mitchell was born in 1919 in Galveston, which is a beach town about an hour south of Houston. His parents are Greek immigrants who came to the U.S. with nothing through Ellis Island in the late 1800s. His dad, Mike, which, by the way, that's not his name. His name is this unpronounceable Greek name.
Did you hear how he got his name changed?
Yeah, it wasn't it that somebody went, so he was working on the railroads and somebody was like, I can't pronounce your name. You're going to have my name. So
Yep.
Mike Mitchell is actually the name of his raroad foreman.
Yeah, I love
couldn't
that. Just like,
pronounce
I'm
it.
just going to call you my name.
Yeah. Matt, your new name is Daniel. So his dad actually back in Greece was a goat herd and, illiterate, youngest of 6 kids, had no future, no real economic prospects there. And so he comes to the US, works on the railroads, learns to read and write, gets the name Mike from his foreman, and eventually settles down in Galveston running a small shoe shine / cleaning business. Lots of colorful stories about Mike Mitchell, a lot of gambling and drinking and how he met Katina, his wife, who is George's mom, and convinced her to marry him. Just a very colorful guy, to say the least. The family struggles financially, but at the same time, George thrives academically. And, he's reading all the time. He actually skips 2 grades, which is a bit of a blessing and a curse for him because he was pretty small going through school. But the main theme for George here, as he's growing up, is there's this recurring theme of this duality of hardship on the one hand versus a lot of green shoots of progress and self-improvement, self-reliance. And 1932, when George was 13, his mom passed away at 44 from a stroke. And George goes on to live with his aunt and uncle because his dad is dealing with recovery from a pretty traumatic leg injury. He finished high school at 16 in 1935. He got accepted to Rice University. I didn't know this, but they told him that he was too young to enroll. They said, we can't have a 16-year-old running around campus. So as fate would have it, he actually went to work for his older brother, who was running rigs in Louisiana, drilling for oil and being terribly unsuccessful. He basically was drilling dry holes. And George goes and works for him, and he dives headfirst into studying this stuff. So he wasn't just out there to work; he was out there to learn. And so he gets a bunch of books on petroleum engineering. He starts reading everything that he could get his hands on, which leads him to change his mind. When he got accepted to Rice, he was thinking he would become a doctor. He wanted to go study medicine. This experience changes his mind, and he decides he's going to go study geology and petroleum engineering. And Rice is not the right school for that. He instead applies and gets accepted to Texas A&M, where he's in the Corps of Cadets, which is basically like going to military school. He almost gets kicked out several times from A&M, though, because he can't pay. So he's very short of cash most of the time that he's there. He ends up graduating 1939, top of his class, gets a job at Amoco, which is at the time a major oil company. It's now part of BP. He gets called into the Army in 1941, around the time of Pearl Harbor. But because of his engineering ability and training, he doesn't get deployed to combat. He gets assigned to the Army Corps of Engineers, doing work on military facilities in the U.S. And when he comes out of that in 1945, 1946, George thinks about going back to Amoco, but he remembers some advice that he got from the legendary petroleum engineering professor at A&M, Harold Vance, for whom, by the way, the College of Engineering is now named. And Harold Vance told him when he was in school, quote, if you want to go work for Exxon, fine, then you can drive around in a pretty good Chevrolet. But if you really want to drive around in a Cadillac, you'd better go out on your own someday. So George remembers that. And naturally, he goes and joins his brother, who's still drilling for oil, but now he has partnered with this guy, H. Merlin Christie, who's a former stockbroker turned oil man, in a company that they call the very creative name of Oil Drilling Co. So Oil Drilling Co. is Merlin, who owns half of it, George, who takes some debt in order to buy into the company and now owns 37.5% of it, and Johnny, his older brother, who owns 12.5%. And George focuses on basically being the technical guy. He evaluates all of the deals, the geology and the engineering, while Johnny wines and dines potential investors and kind of deal makers. And this works out great for them because Johnny had been a terrible wildcatter. He had drilled mostly dry holes, but he's exceptionally charismatic and a fantastic fundraiser, while George is the opposite. He's exceptional at knowing where to drill productive wells, and they make the perfect team. And soon enough, they build a pretty good business focusing on natural gas, actually, which is kind of funny for a company named Oil Drilling.
One thing in the company's early life that I think was an interesting part of the story is that they were so poor at the start of this company that they couldn't afford the rental fees from the local library to rent well logs from the library. And so they actually found a company that would let them borrow them overnight so that George could study them overnight and return them back to that company at 8 in the morning.
Yeah, which is fascinating, right?
Really a company that started from zero. Couldn't afford a rental from the local library.
And he was like staying up until like 2, 3 in the morning so he could return it before the company opened. All right, so soon enough, they build a pretty good business and they're focusing on natural gas. Other companies, other prospectors for oil and gas are really focused on oil, not gas at this time. So the natural gas leases are a little bit cheaper and less competitive. And on top of that, they could buy a partial interest in de-risked projects, right? So maybe someone drilled a well and they found gas and they don't have the capital to fund 100% of the development, maybe the next well or even the completion of that first well. And so they will sell a portion of their interest, right? This still happens. This is very common today. Typically, you don't have a well or a lease that is owned 100% by a company. You'll have partners that are not operators that are effectively participating in both the capital and the returns associated with a given well, but you have somebody else who actually owns the majority and operates it, right? Very common in the oil and gas industry. This is what they were doing. They were basically looking for ways to participate in wells that had been de-risked. So they're not going out there and necessarily poking holes in the ground, just sort of haphazardly trying to find oil and gas. They're going after de-risked projects that are less competitive because they're gas. All of which ends up leading to a fateful day in 1953 when one of their investors, this guy who was very colorfully called General Louis Pulaski, who is not a real general, he calls George and he tells him, quote, my Chicago bookie has a deal in North Texas and he wants you to look at it. So there's this whole chain of communication of how this deal gets to George, but eventually through one of his investors, it lands on his desk. And this deal turns out to be in an area known to locals as the frustration fields because so many dry holes have been drilled there. So a ton of other operators had tried to drill in this area to try to prospect for oil and gas. Nobody had been successful. George looks at the data and he sees that everyone else missed 100 feet thick sand layer that seems to be loaded with natural gas. And so I want to pause here for a second because you and I, have maybe a decade worth of experience in oil and gas and understand what this stuff means technically, but this is all pretty abstract if you haven't done that. So there are two things that I think are critical to understanding this story. One, these gas formations are like 3,000 feet deep underground because this is conventional gas. So for anybody who's actually in the oil and gas industry, they'll know that when we eventually talk about shale, we're going to be talking about formations that are much deeper than this. But this particular field in North Texas was about 3,000 feet deep. And it's hard to imagine what that actually means, right? It's very abstract, but I want you to picture like standing on one side of Central Park, let's say at the Met, and looking across to the other side of Central Park, where maybe the Natural History Museum is. That's about 3,000 feet. That's actually a little bit shorter than 3,000 feet. So it's a pretty big distance underground. A couple of Empire State Buildings stacked on top of each other. Number two, the second thing that you need to understand is that the data that George is looking at is called a well log. And a well log is like an MRI of the earth. So you send sensors down the well, and those measure different properties of each layer of rock. So there's layers upon layers of different types of rock stacked on top of each other underground. Some are more dense. Others have pores or, they trigger electrical or radioactive signals. And when you put all these different signals from the different sensors together, you can start identifying patterns. That means that there's a rock with maybe little empty spaces or pores, and those might be filled with oil and gas. So that's what George is looking at. He's sitting on his desk looking at this long sheet of paper that is tracking all these variables down the well, and he's trying to identify in all these different layers of rock where there may be the potential for oil and gas. And he sees that there's 100 feet of this layer that seems to have a lot of natural gas, and everybody else has missed it. Everybody else has just drilled right past it.
And at this time, too, in that process, one thing that's going to change through our series is the percentage of success at this stage in the industry is pretty low. We think we see gas, we're going to go spend money to get it, and the success ratio is quite low at this point in the industry's development.
I would also say like a good analogy, and this won't necessarily be super applicable to everybody, but if you studied financial markets, you have probably studied The Intelligent Investor and Benjamin Graham and the precursors to what Warren Buffett ends up using as the frameworks to invest back in like the 50s and 40s. All of those frameworks end up making financial markets more scientific and more sophisticated and more rigorous. Arguably, that is what's happening in the oil industry around this time in the 50s also, which is that people are bringing science, real frameworks for how to evaluate, where to drill for oil and gas so that they can have more repeatable success, so they can increase that chance of success. Now, there are still places in the industry that have really low success rate, which is like rank exploration, in the middle of nowhere. But even those have way more sophisticated scientific processes to try to identify where might there be oil and gas. You're not just like looking at a hilltop saying, hey, there may be oil and gas here, and I'm just going to poke a hole in the ground. That is not happening anymore. And that starts in the 50s. So back to George. Johnny and George convince their investors that they should invest about $10 million to develop the frustration fields. Remember, everybody else has failed here, but they go and convince their investors. They have enough credibility because of their track record up to this point, and so they get the money. They officially start drilling it, and they are successful. They make some good wells, and this turns into what's called the Boonsville Bend gas field. So frustration fields label is gone. Now it's called the Boonsville Bend gas field. They end up leasing about 300,000 acres over 3 months for $3 an acre, which is a great price. And they hit commercial gas production in 85 out of 87 wells. So massive success rate. And all of that development, they largely fund with debt. So they were drilling a well, they were successful, they would then put debt on it and go move on to the next one. There are two things that are important in terms of how they were thinking about investing at this time. One of those things, and George, this is true of George in particular, is that he was convinced that inflation, again, this is the mid-50s, he was convinced that inflation would erode that principle, the principle of that debt over time. And so he was perfectly comfortable putting a ton of debt on because he knew that if inflation spiked, that the value of that principle would go down. They would be repaying with inflated dollars, and so that was good for them. The second piece that really drives a lot of the decision-making here is the price of gas was lower than oil. in terms of energy equivalency. So this is something that people use in the industry to try to figure out how much energy content is in natural gas versus oil in a given unit of oil versus a unit of natural gas. And so gas at the time was about 9 cents. To reach energy equivalence with oil, it would have to go up like 2 to 4 times. And so obviously, if that happened, there would be a big windfall if you can buy gas assets, assuming the lower price. And then as the gas market reaches equivalence with oil, which is the thesis that they're investing with, then just because of the price movement, you're going to realize a 2 to 4x return on your investment. And so that's sort of the philosophy, right? Inflation and gas price equivalency with oil. There's one big problem with all of this, though. And this is a massive problem. You don't just produce gas and turn it into money. You need a market to sell that gas into, right? And the dominant natural gas buyer in this area in North Texas is a Dallas utility called Lone Star Gas that effectively squeezes producers because most of them want oil. So if you're a producer and you end up drilling a well and instead of finding oil, you find gas, you just want to get rid of it. They can't give their gas away fast enough. Sometimes they just burn it. Like nobody wants gas. And so Lone Star is paying 10 cents for natural gas and they only buy in the winter. So it's not even like there's a market the whole year long. So if you're producing gas, you have to shut in your well until Lone Star is willing to pay you a pittance for your gas only in the winter. And so if George and the company want to make money here, they have to find a better buyer, right? They have to find a higher price, a more stable contract structure, ideally somebody who agrees that gas prices will go up in the future and wants to lock in the supply before it's too late, before that happens. And they find that counterparty. And that counterparty is a very special company called the Natural Gas Pipeline Company, NGPL, which at this time is part of the utility for Chicago. And in 1955, George Mitchell signs a 20-year deal at 14 cents per MCF with NGPL, which is almost twice what the spot market was going for in North Texas with Lone Star Gas. NGPL has a pipeline that runs from North Texas to Chicago, but they need more gas because the reserves are dwindling. By this point, everyone expects that gas prices are going to go up substantially. And more than that, Chicago's gas demand is growing. So NGPL needs a steady supply of gas that is close to their pipeline and that they can secure for as long into the future as possible to avoid price spikes and just have the stability of, the deliverability of that gas into their market. And the Boonsville gas is perfect for this. But more important, this contract is going to set the groundwork for the Shale Revolution. And we're going to get to that. But there are a lot of variables that build up to that moment. In my opinion, this is probably the most important one because these above market prices and the stability of a long-term contract for Mitchell that escalates with inflation guarantees stable cash flows for them. And not only that, but then in the future is going to put a lot of pressure for them to be able to keep up with the demand from this contract and to be able to find enough gas to keep extending it.
And putting this NGPL contract in its sort of historical context, I think, is fascinating. So I didn't appreciate that before World War II, there really was no natural gas infrastructure in the U.S., mainly because the technology to ship gas in a pipe didn't exist yet, believe it or not. Like stainless steel and advanced welding techniques were something that came out of all the innovation related to World War II. And so you came out of World War II, the next 25 years saw this massive CapEx boom for the rollout of a national natural gas pipeline system. This is on par with the railroad rollout and the telecom rollout. Actually, if you look at it on a dollar spent per year, it was bigger than those because it was so concentrated in that 25-year period versus telecom and railroads were closer to 100 years across a couple different cycles. And one of the really important attributes of those three things that they share is that they're all actually privately financed. And when you look at the opportunity to invest in this massive pipeline rollout in the 25 years following World War II, it screens as like maybe the most attractive private investment opportunity ever when you look at it, right? Because energy was super regulated during this time. And so these pipelines actually had guaranteed profits. They had long-term take-or-pay contracts with like cities, right? So like very, very high quality counterparties. They had natural monopolies, right? Because this is very high CapEx and you needed the right of way and all these things. I read that at one point, Mitchell Energy was supplying 10% of Chicago's natural gas demand. And it's all in the context of this like huge, I mean, this is a huge infrastructure build out.
And the beauty of commodity markets is that if you have access to supply of the commodity and you can get it to market, as long as you're not a immediate default risk, you can probably get a deal done on some terms and, maybe build a company around that. And that's exactly what they're going to do. I think before we dive too much deeper into George Mitchell and the rest of the company story and how it affected the Shale Revolution, I want to double click a little bit on this market piece, because if you think about energy markets in general, right, and you go through all these major inflection points in terms of market structure, demand supply dynamics, and geopolitical pressures and technology, all of which are kind of critical to the decisions that George Mitchell and his team are going to make leading up to the Shale Revolution. If you go decade by decade, when Mitchell signs this contract with NGPL in 1955, U.S. gas is like you said, a tightly regulated, very local and regional business, right? And the way it looks is basically a bunch of interstate pipeline companies locking in long-term supply deals and then reselling that gas to utilities, just like they're doing here. In the 60s, natural gas demand kept growing in that post kind of World War II boom. Cities are growing, industries expanding, right? People are switching from coal to natural gas because it's cleaner and more efficient. Natural gas is being adopted residentially for heating and appliances, and then utilities are investing in natural gas generation. And so while all that demand is kind of spiking, prices are really tightly regulated. And George Mitchell signed this deal for 20 years, right before all this went into effect. In fact, they were impacted. The price that NGPL was willing to pay was actually higher, and they had to come down to fit in with these regulations. But otherwise, the price in the market is artificially held low relative to all this demand in the 60s. And so what ends up happening is that regulators are so focused and so concerned on protecting consumers and the demand side and mitigating monopolies that they end up creating this terrible distortion in the market. So you have this growing demand fueled by artificially low prices, but those same low prices discourage new drilling. And so reserves aren't getting replaced. And by the way, I don't know if you came across this, the majors were big supporters of a lot of these policies. They were all exploring and producing from cheaper fields internationally in the Middle East and North Africa and elsewhere. And even though smaller independents were trying to warn politicians, this actually has a lot of connection to narratives that are playing out today in terms of potentially reshoring certain manufacturing, et cetera. At the time, smaller independents are trying to lobby politicians saying, hey, there's a danger on relying on energy imports so much, but they didn't have enough political sway relative to the major oil companies that are basically importing and making a lot of money from that. And so they don't convince anyone. By 1965, the production of natural gas flattens out, reserves start declining pretty steeply, and it's a trend that's not going to reverse itself until the early 2000s with the Shale Revolution. So we go through this about 40-year period in the US where natural gas domestic reserves are declining, which informs what happens in the 70s, right? Because all of this leads to the energy crisis decade of the 70s, which is textbook, economic crisis mode, huge inflation, energy supply issues, massive double-digit interest rates. The Carter government is so worried about natural gas supplies that they deregulate the wellhead price. So they finally realize that this price regulation is not working, but only for newly discovered gas to try to incentivize additional drilling. But at the same time, they pass a law in 1978 banning power plants and industry from using natural gas, which then reduces the consumption, right? It reduces the amount of demand for natural gas. And so it adds a bit of insult to injury to natural gas producers that were hoping for better prices, but now there's a ton of demand destruction. To give the government some credit, one thing that they do during this period that does have long-term impact is they create a couple of agencies, one of which is the Department of Energy, to fund R&D into energy to try to find more energy alternatives, sources of unconventional resources domestically. And so they fund basic studies to assess how much oil or gas might be in places that are underexplored in the US. And they also fund basic research into technologies like what we think of modern hydraulic fracturing, which had been going on, like hydraulic fracturing had been going on for decades, going back to the 30s and 40s. But this basic research that the government funds gives a big boost into modernizing the concept of hydraulic fracturing. And they also implement other things like tax incentives on certain production like shale and other unconventional part of the production mix that is only fueling less than 5% of production in the US. But they're hoping that with some of this subsidizing and some of this R&D, maybe that can grow. It's
Yeah,
very, very speculative.
government's doing everything they can in the 70s and 80s to increase production, domestic production of not even just production, but just trying to increase. Go look for it and produce it.
Yeah,
They're
And
doing
what's
everything they
funny,
can.
like half the policies are sort of like pressing on the gas and trying to encourage new supplies to come on board, and then half the policies are kind of pressing on the brake a little bit and discouraging new supplies and sort of encouraging energy imports. And so there's this weird duality, but the government does get credit in terms of funding some of this basic research that led to big technological breakthroughs. Meanwhile, George, by this point, had consolidated control of Oil Drilling Co. in 1972 and decides to take the company public to finance more drilling. So he had become a little bit frustrated having to go to these investors, these individual investors, for every project that they wanted to do. So they want to keep up with these natural gas volumes. They have this fantastic contract with NGPL, which is by this point almost into its 18th year or so. They want to extend it. And so they need to go find more gas. So he wants to go public to finance some additional drilling. As part of the IPO, he changes the company name to Mitchell Energy and Development Corp. And that is going to be the name of the company going forward. And George is going to be in control. Transitioning into the 80s are all about deregulation, right? The Reagan years. And so natural gas prices are gradually freed from all these caps that were causing distortions in the market. Drilling technology improves quite a bit. And then the pipeline business becomes a lot more competitive, which is much better for producers, right? So now you have to have open access and competitive bidding across all these pieces of infrastructure to get natural gas and oil to markets. But unfortunately, as any booming period in the oil industry is bound to do, this leads to a classic bust in prices because everybody rushes in and starts producing as much as possible. And so if you look at a chart in the 80s, the late 80s are like the worst decade for U.S. oil and gas. And, you can kind of see this in the demographics of the industry too. Not a whole lot of people were going to work in oil and gas during this period. It was kind of a terrible time. Market is oversupplied. Natural gas from the growth in production following deregulation creates the pricing bust in gas. And then on the oil side, this is interesting because it's reminiscent of what we're going to talk about later in this series. In the 80s, Saudi Arabia decides to defend their market share. And they increase production, they ramp up production, even though demand was declining. So naturally, prices crash. So it's not just the industry that's going through a bust. When George Mitchell negotiates an upgrade and extension to its gas agreement with NGPL in the late 70s, he asks his team to estimate how much longer Boonsville will produce. Their forecast comes back to George. It's about 10 years. And it shows that by 1992, they're not going to be able to drill new wells to keep production flat. And reserves would start declining by then, and they would fail to keep the volumes required by the NGPL contract. And this becomes the sole problem in George's mind to solve at Mitchell Energy. George has a bunch of other projects that he's working on, but as far as Mitchell Energy is concerned, this is the thing. How do you replace reserves? How do you grow production? How do you make sure that you can meet the obligations of this contract so you can keep the cash flowing? And remember, Mitchell is a public company and it has a decent amount of debt to service. And so more than that, when you evaluate your options, if you're not going to issue equity, you don't have the capacity to issue more debt to finance growth projects. Really, the only thing that you can do is try to figure out how you're going to grow from your existing asset base, right? How are you going to grow production from the assets that you already have? And there's only one obvious solution. Very non-trivial, but very obvious, which is the source of the gas that they're producing in the Boonsville field in North Texas at 3,000 feet. If you look 3,000 feet deeper at about 6,000 feet, the source of that gas is something called the Barnett Shale.
So I always thought of shale as the source rock, right? People call shale the source rock, meaning like this is where the oil and gas formed originally.
Yes, that's right. Yeah, exactly. So basically, the reason why it's called the source rock is because usually underlying a conventional formation that is sandy and porous and has permeability so that oil and gas can flow to the wellbore, you'll have somewhere either below it or adjacent to it, there will be a shale much deeper where the oil and gas actually got cooked. And over millions of years, the oil and gas basically kind of flowed upwards to zones of less pressure. and accumulated in a reservoir. Now, what's interesting is that there's really only two pathways, right? Like that oil and gas is going to flow out of where it gets cooked from, the source rock, the shale, and it's either going to go all the way to the surface. And there's a lot of anecdotes throughout history of people in ancient times using oil that was seeping into the surface for different things. Or more than likely, that oil and gas is actually going to flow up and get stuck underneath something else that is impermeable, that doesn't allow it to flow all the way to the surface. So whether it's like a salt cap or another, shale layer where that oil and gas just can't flow through. And when it gets stuck, that is a conventional reservoir. That is the place where conventionally, historically, oil companies have gone through and drilled a hole. And what happens is if you drill a hole in there, the hole itself has a lot less pressure, right? Because it's coming from the surface. And so it's like a straw. All this stuff that was really packed up in this reservoir wants to float to the hole and then come to the surface. And that's a conventional well. However, in shale, if you drill a hole into it, you're going to get a little bit of oil or gas, but it's not going to flow because the shale doesn't have all these connections, right? Like it's almost like this giant tank, but the tank is not connected. It's just like little microscopic, containers in the tank. And so if the tank is not connected across the whole thing, there's nothing for it to flow.
And I think this sort of geological lesson also has a major impact on where the oil and gas industry is right now, right? So in the 70s and 80s, the majors are gone, right? The Chevrons and the Exxons of the world and the Shells, right? They have left the U.S. and they are exploring internationally. Believe it or not, before the 70s, the U.S. and specifically the Texas Railroad Commission was effectively OPEC, right?
Yeah.
And then in the early 70s, it all the thinking was the U.S. There are no more conventional reservoirs. We're out of oil and gas was the thinking at the time, and so the majors went elsewhere looking. So all this development that's happening is from the independent oil and gas companies, the wildcatters, the small guys, and it was actually taught in school, right? That you can't get oil and gas out of shale, that you cannot get oil and gas out of the source rock.
Yep. And yeah, none of this was particularly novel on the understanding of what a shale is and the fact that it's a source rock. But you're absolutely right. Basically, the conventional wisdom, and this is true, until the early 2000s, the conventional wisdom is that you cannot produce. It's not a question of whether there is gas or oil in these, shale formations. It's just that you can't. The conventional wisdom is you cannot produce it. You simply can't tap into it. You'll never be able to get it out economically, right? And so basically to make a commercial well that might cost you, hundreds of thousands or into, $1 million+ dollars, you need to drill it. You need to do what's called completing it, which is sort of stimulation, some sort of pressure.
The explosion part.
Yeah, some explosions that go on in the rock to crack it and to really get the flow going into the well. And then you have to produce enough at high enough prices so you can earn back your capital and earn your return. And if you drill a well with conventional technology in the 80s, targeting oil or gas and shale rock, you get a little bit of production, but it very quickly dries up because you're only draining a tiny bit of those containers right next to the wellbore. And the rest of the nearby oil or gas doesn't flow towards the wellbore. It's sealed rock. So what's the problem? The problem is the early 80s, nobody knows how to get gas out of shale economically. And it's not for lack of trying, because the government had funded a big research project in Appalachia in the late 70s that concluded that producing from shale wasn't economic, even with hydraulic fracturing, right? Even with some of the most sophisticated technologies to try to crack the rock and try to connect, and fracture the rock around the wellbore. You could pump gel and water and all this sand to try to prop up the cracks that you make, and it still won't flow. It just doesn't work. However, at Mitchell Energy, George Mitchell is very motivated. He needs to figure this out, right? He's sitting on top of a gold mine, and he needs to figure out how to unlock it. And one of his geologists, this guy named Jim Henry, writes a paper in 1981 that catches George's eye because he says that the Barnett Shale is the source rock for Boonsville and that it has lots of gas. And to George Mitchell, this would be like discovering a brand new gas field, right? That you didn't have to go and explore for, right under his main asset. And so in 1981, they drilled their first Barnett well, the CW Slay number 1, and it's a terrible well, except for one thing, which is that when they drill through the Barnett, there's a ton of gas. They describe it as drilling through a snowbank. There's a ton of gas, but it doesn't draw the surrounding gas. But what they drill through shows that there's a lot of gas per unit of rock. And so this is like the first point of conviction for George Mitchell, right? Like this is the first signal of what ends up becoming a legendary contrarian bet that nobody else but him and a couple of members of his team actually believe in, right? Most people in the industry still thought shale couldn't even hold oil or gas because it had no pores, or it was believed to have no containers for the oil and gas to sit in. And the CW Slate #1 showed that, no, actually it does. It holds a decent amount. You just can't get it out. You can't connect it. And so then the Mitchell team decides to frack the well to see if they could crack the Barnett Shale and connect the other parts of, to flow more gas. They didn't pull this out of thin air, right? Mitchell Energy had actually pumped the largest frack job in the US in 1979 with funding from the government in another field in Texas that was not shale. And that frack had doubled the well's production. But even with the government covering the cost for that well, because the gels that you needed to use for the fracks were very expensive, that well was only marginally economic, right? And again, it wasn't shale, so it was much easier to try to fracture the rock and create cracks for the gas to flow. So the Mitchell team ends up taking about a dozen of the existing Boonsville wells. In other words, they don't have to drill brand new wells. They just take existing wells to make it a little bit of a cheaper project. They drilled them a little bit deeper. They fracked the Barnett with different types of fracks, different experiments. And these all end up being marginally economic wells, mainly because of the inflated prices that they get from the NGPL Chicago deal. Otherwise would have been unprofitable, right? Because they're basically getting like 3 to 5 times the market price for gas in this long-term deal that they had. By the end of 1989, the whole industry is in a slump. And Mitchell has drilled about 45 Barnett wells, all of which are at best marginally economic, if not uneconomic, only because they're benefiting from the NGPL gas contract. And do you know how many non-Mitchell wells have been drilled in the Barnett at this point? So they had drilled 45. There's only 6.
Yeah.
There are only 6 wells that are not Mitchell at this time. So nobody else is doing this, right? Like, this is crazy. This is really far out there on the cutting edge of kind of experimentation. And if you think that's bad, things go from bad to worse, because at this point, Mitchell Energy gets sued by the landowners of North Texas, claiming their water is contaminated with gas from Mitchell wells. Again, this has nothing to do with fracking. This is actually a lawsuit related to their Boonsville conventional gas field. A judge actually ends up awarding $200 million in damages to the landowners that were suing Mitchell Energy, which puts massive pressure on the company. And get this, the attorneys that are representing the landowners would get $80 million of that $200 million. And the judge that is ruling on this case had actually worked for the law firm of those attorneys and still had an economic interest that allowed him to collect 20% of contingency fees from cases that the firm worked on. So talk about a conflict of interest.
Wow.
And this is key, right? Because ultimately the Shale Revolution is going to get caught up in similar water controversies later in the 2000s. Mitchell eventually appeals the lawsuit and they win. The ruling gets up getting thrown out. They don't have to pay $200 million. Mitchell Energy comes out of all of this in much better shape financially. Not only did they avoid having to pay the $200 million at the time, when the whole company was worth maybe $1 billion, but they're forced to sell their real estate assets, because at this point they had a substantial real estate business inside of Mitchell Energy, and they're forced to sell George's favorite pet project, which is the Woodlands, which he had developed from scratch as this sort of idyllic, sustainable community. And so they sell these for about $400 or $500 million to raise capital, to get the balance sheet in better shape. Wall Street loves this because now they're a pure play energy company. And by 1997, when all this stuff gets sorted out, the stock closes 45% higher than like 18 months prior. So they get a little bit of a respite. Around this time, let's go back to the mid-90s a little bit to talk about how they built conviction in the Barnett. So the Barnett had gas. They had proved that. They could frack it to try to make it flow, but they're just not getting enough gas, right? Like, it's done a ton of experimentation by the mid-90s. They're just not getting enough gas to make it economic. They have about 200 Barnett wells at this point, but they make up about 10% or less of their total gas production, so not very much to show for their capital investment so far. And in mid-1995, another curveball, they get a letter from NGPL saying they're going to buy out the contract, their gas contract into Chicago. They're going to make a series of payments totaling about $242 million. So Mitchell Energy is going to get some money out of this, some cash, but they're going to terminate the contract by January 1st, 1998. So that means that they need to figure out the Barnett fast, right? They have a bit of cash. They have to go deploy it. They have to figure this out. They can't buy more assets to grow. The company's going to go sideways, if not have to shut down if they don't figure out the Barnett. They're going to be toast if they don't get more reserves. They are going to be exposed to market prices, and they have a ton of debt still on the company. And more than that, this is very personal for George Mitchell because he's not liquid, right? He's basically, as a lot of founders of companies are bound to do, he's using his equity in Mitchell Energy to finance his life and his philanthropy and other projects. And so a lot of that is levered, right? Like he's got debt against his equity in Mitchell Energy, which is publicly traded and subject to the volatility of share prices. And so it's a bit of a house of cards. Unless they crack the code on the Barnett and make the Barnett commercially valuable, everything that he has built up his whole life might go up in flames. And so to highlight how non-obvious of a project this was in the Barnett, by this point, George has this guy, Bill Stevens, as president and COO of Mitchell Energy. And Bill had run Exxon's U.S. operations. So he had a very senior role at Exxon. He had retired there a couple of years earlier before George reached out to him, put him on the board, and then eventually asks him to run Mitchell Energy. Bill Stevens hates the Barnett project, right? This guy who had like 34 years of experience at Exxon, he hates the Barnett project. He thinks it's a waste of resources, a waste of capital. There's a great story of how much he hates this. There's another guy who's pretty critical in kind of building the conviction at Mitchell Energy around the Barnett to keep going with the project. His name is Kent Bowker. And he's a geologist that joined Mitchell in early 1998 from Chevron. And Chevron, interestingly enough, under the leadership of their head of North America production, a guy named Ray Galvin, had championed a Barnett project too. And the thinking was similar to Mitchell's, right? Like they thought, look, the gas is there. We should be able to get it out. How do we get it out economically? And it was a real cutting edge science project without a known answer. They're poking in the dark trying to discover a major insight. When Galvin retires from Chevron, the guy that takes over doesn't think that this is worthwhile science to be doing and wants to prioritize oil in Kazakhstan. And so they shut it down. They shut down the project. And that's how Kent ends up at Mitchell. But the key is that Kent brings with him all this work, all this knowledge that he had done on the Barnett at Chevron. And he effectively builds an analysis and takes it to the board at Mitchell that shows that, look, not only do yes, you guys believe that there's a lot of gas here, but you're wrong. There's not a lot of gas. There's like 2 to 4 times more gas than you actually think. All of the work that Mitchell had done was based off of some Appalachian extrapolation from a government-funded shale study. And here comes Kent with Chevron proprietary data on the Barnett itself saying, hey, a lot of the variables that you're using as inputs in this model are wrong to the downside. There's actually multiples of the amount of gas buried here. And of course, George, kind of lights up and builds a ton more conviction, and they double down, right? So the story to highlight how much Bill Stevens still hates the idea of the science project. Apparently, Kent, on his first week of work at Mitchell, runs into Bill Stevens, the COO of the company, in the break room. And, he's giddy and excited. He just got there, and he's like, I'm really pumped to be working on the Barnett. And Bill, before Kent has a chance to even finish his sentence, puts his hand up and he's like, I've had enough of that stuff. He just walks away from him.
I mean, one of the ways I thought about how non-obvious the drilling in the Barnett was and hanging the company's future on the Barnett was that Exxon's headquarters was very close
It's right on top of it.
Yeah. They're in Irvine. They're based in Irvine at this time.
Yep.
And so, one of, if not the largest oil and gas company in the world is based in the Barnett.
Yeah.
And they're not doing anything there. right? And so this is a super non-obvious, non-consensus thing that Mitchell Energy is doing here.
Yeah.
And it hadn't really dawned on me that, like, I think part of what you're saying is with the NGPL contract, like, that was kind of Mitchell Energy's thing, right? Their thing was, we have this contract to sell into Chicago at above market prices, and we have certainty of a buyer, and we have certain economics. And now with that contract expiring, they don't have a thing now. And so
Yeah.
they're like, we need what's in their public company. So they need to have something to sort of drive growth.
Yeah, totally. And if you think about the way reserves work too, they were probably getting credit for that pricing in their reserve base that justifies how much debt they can take on. And if that pricing gets reduced now down to the market price, that probably adversely impacts the reserves too, right? So like there's just a lot of second order effects from that contract, going away, and from them not having certainty to replace their existing reserve base and survive as a company.
Yeah, and
Yeah.
worth touching on this whole period we're talking about, World War II all the way to almost the end of the 90s, natural gas prices are low. Right?
Super low.
There's
Yep.
not a single point in there where there's like a great, awesome, 5-year period where natural gas prices are really high. That happened with oil a couple times in that
Yep.
period. But for this whole time period, natural gas prices are very low. Like, I think below $2 per.
Yeah,
MMBtu.
the ceiling is basically $2 up until the 2000s. They're $1 to $2 this whole time period. And to go back to Mitchell, I want to harp on something that's super important here. This project wasn't just a contrarian bet relative to industry philosophy. This was contrarian inside of Mitchell Energy. Like, it was very controversial internally. It was so unpopular that it was considered almost a dead end to get put on the Barnett project. There's this guy who we talked about at the beginning, Nick Steinsberger. He actually gets a promotion, but the promotion is to go run the Barnett program. And when he shows up to his first meeting with the reservoir engineering group and they tell him the Barnett isn't working, they basically say, hey, you will probably be able to drill at most another 30 to 40 wells, and then we're going to have to shut it all down because this just doesn't work. It's just not economic. This isn't going anywhere. And so Nick comes to the conclusion that, okay, well, if the wells aren't economic, there's only 3 levers that we can pull on, one of which we don't really control, which is prices. The other 2 are either we increase volumes or we reduce costs. And the easiest thing for me to do is to go start looking line by line and figure out, how do we cut costs as much as possible to reduce the expense, the capital expense of these wells. It cost about $800,000 to drill and complete one of these wells. And about half of that was the frack, with 100 to 200,000 of that being the gels, the really expensive gels that are used to thicken the fluid so that the sand gets suspended in it and then can flow into the formation and try to, prop open the cracks that get created in the shale. And so there's a couple of reputable sources that differ on exactly what happens next. By one account, Nick is fracking a well and notices that the gel isn't mixing and the fluid ends up being mostly water that they're going to pump down into this well. And so they're already starting. And so he decides, well, what the hell? We're just going to keep going. The well ends up being just as bad as the others, but it's not worse, which is kind of a key insight. It's an interesting way to frame it, but it's not worse, even though technically the frack was screwed up and it's mostly water. And so as he's trying to understand why, he goes to a baseball game with engineers from another company called Union Pacific Resources, who mention that their company is doing something called slick water fracks in East Texas. They're stimulating a conventional formation called the Cotton Valley. This is not a shale. This is a sandstone, so a much more permeable rock, with actual containers that connect. But they're using these mostly water fracks to stimulate that formation and enhance the amount of flow that they're getting into the well. But Nick realizes, hey, like, if these guys are doing it, maybe I can do that, because if we can cut out the gels, that's a super expensive part. If I can reduce the cost of these wells by 20%, that's massive, right? 25% cost reduction. That will have a significant impact on the economics of each one of these wells. They have no idea why it works, by the way, the Union Pacific guys, but they say, hey, it does work. We don't know why, but it does. But it gives Nick the conviction that, hey, maybe the slick water fracks will also work on shale. The other account, by the way, is that he decides to try slick water fracks for the first time after chatting with them, and that there may not have been an original mistake. I think, you can pick whichever story you like better. But either way, Nick goes back to his management team and proposes that they frack a series of wells with slick water fracks to test this theory. Most of them are super skeptical, except maybe a couple But to their credit, and knowing that George Mitchell was really focused and pressuring them to figure this out, they agreed to try it, and they let him complete 3 wells in the spring of 1997 with slick water fracks. They all fail. They screen out, which means that the sand that gets pumped down to prop open these fractures that get created gets stuck when the well is flowing back. They get stuck in these filters on the wellbore, and so they prevent the flow of natural gas from coming into the well. And so Nick is sitting there like, poring over the results, and he realizes the problem is that this is not the same as what Union Pacific is doing in East Texas. They're pumping into sand, which has much higher permeability, and the sand is actually going into the formation. It's not coming back to get stuck in the filters. The shale can't absorb the sand, right? And so if you pump the same amount of sand into the shale, it's all going to come back and it's going to get stuck. And so Nick goes back to senior management at the end of 1997 to present these findings, these conclusions that he came to, and ask for 3 more wells to continue the experiment. And remember, Mitchell Energy, is still against the ropes. They're laying off people. In interviews, Nick says that at this point, he's so dejected, right? He's so cynical that this isn't potentially going to work and that his career might be over. He's going home and he's just walking straight into his bedroom without even saying hi to his family. Like he's just depressed, and he thinks he's probably going to get fired. But at least, senior management agrees to let him try another round of 3 wells with slick waters. And one of these ends up being a well called the S.H. Griffin number 4. And what Nick does to experiment in this particular well, which changes everything, is that he's going to use the slick water frac, but he's going to reduce the amount of sand. And then as the frac is going, he's going to gradually increase the concentration to try to avoid that screening out from happening again. And this well ends up being the best Barnett well they had completed to date. So doing some back of the envelope math, these wells cost about $600,000, right? Because they had reduced the amount of gels in them to a minimum. So about $600,000. They produce a little over 1 million cubic feet per day. Gas was hovering around $2 in 1998. So if you do the math, this well is marginally economic. So it's not like a gangbusters, 30, 40% rate of return. Probably didn't beat the cost of capital, but it was close, right? And it was much better performance than anything else they had done. It certainly would have been very economic if gas prices were closer to like $4 or $5. And that's, by the way, where gas prices are going to head here in like a year or two into kind of like the late 1999, 2000 period. But before that, Mitchell Energy, looking at these results, is like, we may have cracked the code here. We may have something finally. They double down in slick water fracs, end up drilling 60 Barnett wells in 1998, all of them with slick water that are 30% cheaper and mostly water, and they gradually add the sand. But just as the Barnett Shale is starting to show green shoots, another curveball, financial markets are teetering on the edge of disaster in 1998 because Russian debt default, long-term capital management collapse, which, by the way, we keep dancing around. At some point, we'll have to do a proper series covering that because it's fascinating. But the price of Mitchell shares is falling. George has a ton of financial pressure on his personal loans because the collateral is the value of those shares. No one in the industry, and definitely no one on Wall Street, cares about the Barnett or any of these, marginally successful wells that they just figured out how to drill. And what's more, George's wife, Cynthia, her health is deteriorating. She's later going to get diagnosed with Alzheimer's. And George himself is fighting through prostate cancer, and he's 79 years old. So with natural gas prices looking up a bit in late 1999, George decides that they're going to try to sell the company. So they hire Goldman. They take the deal to market. No one is interested. So this company, Duke, which is a big natural gas company, Anadarko, another operator in the oil and gas industry, and Devon, all look at the deal and they all pass. George is pissed, by the way. You mentioned the dot-com earlier. Like, he's watching all these startups that have no assets and no real business models go public and make a bunch of paper money. And he's got, a giant asset over here, and he feels like he's discovered something very novel in natural gas markets, and he's getting zero credit from the market. So he's pissed off. Bill Stevens, his COO and president, and George, they decide they're going to grow production to try to prove this out and maybe try again to sell the company later. And boy, do they, because they produce, in 1999, they're producing 100 million cubic feet per day. of natural gas. By 2001, so a little less than 2 years later, they're producing over 300 million cubic feet per day. And they had leased 600,000 acres in the Barnett. That's like one Rhode Island. It's the equivalent of Rhode Island. So finally, in late 2000, people start to notice. And one guy in particular, Larry Nichols, who's the chairman of Devon, thinks that, hey, maybe we missed something, right? We looked at the deal about a year ago. Maybe we missed something here. He calls up George and he asks if they can take another look. And in August 2001, Devon agrees to buy Mitchell Energy for $3.5 billion at 20% premium over Mitchell's stock price at the time. George ends up with $2 billion out of all of this. Nick Steinsberger worked for Devon for a year and then he moves on to another job. So doesn't get any of the financial rewards. Bill Stevens joined the board of another independent after selling Mitchell, an independent called EOG Resources. And we're going to talk about them very, very soon in this series. And Devon went on to ramp up drilling in the Barnett pretty significantly, making highly economic wells with higher gas prices in 2001, about $4 or $5 per M. And importantly, Devon figured out how to successfully drill Barnett wells horizontally. Because at this point, Mitchell Energy had drilled 3 or 4 horizontal wells. They had all been failures. And they had decided, we're not going to do that anymore. We're not going to potentially muddy the waters of an acquisition. And so they just kept drilling verticals and making that work marginally. Like they were marginally economic wells. They were good wells, but they weren't like gangbusters. But Devon does have the wherewithal to pursue horizontal drilling with hydraulic fracturings into the Barnett Shale that Mitchell had figured out. And effectively, if you think about the logic of why horizontal wells are much more economic, is that you're only spending the capex to drill vertically once, and then you're going to cross the whole shale formation, so exposing the wellbore to a lot more surface area of that natural gas formation. And then when you frack that, you get a ton more volume out of a single well. And so if you think about it, what you're effectively doing is you might be doubling the cost of drilling and completing the well by going horizontal, but you're multiplying the amount of volume that you have access to by like 3 to 4x.
Right.
So it's massively economic.
Right. When I think about Shale Revolution as a technology breakthrough, which is what it is.
Yep.
The primary breakthrough was fracking. That was kind of the source breakthrough. And then horizontal drilling is what scaled the breakthrough. And then there were also a lot of sort of supporting characters in the technology breakthrough that weren't primary, but were super important. Like I think advances in computer imaging and seismic technologies were huge. And then there were just all kinds of advances, and there's going to be a lot more to come in the next 20 years we're going to cover. But like, for example, like diamond studded drill bits, right? That in horizontal drilling made it, was also a big breakthrough.
Yeah.
And so there's a number of smaller technology breakthroughs that are kind of clustering around this breakthrough with fracking.
Yeah. It's basically putting it all together in order to create this new thing that is much more than the sum of the parts was, independent of each other. And I think it's fair to call this basically the Netscape moment in the Shale Revolution, because Devon buying Mitchell Energy is the thing that takes this discovery and legitimizes it in a way that is now going to scale, and not just scale inside of Devon, but be replicated by other companies and go on to really make an impact on the global energy landscape, which really is sort of the global economy, right? It's everywhere. It's a critical thing that affects everything today. So with that, let's talk a little bit about some lessons that we can take away from this first part of the series. To me, I think what's interesting is the through line of this story is you have this really smart, really stubborn visionary, George Mitchell, who is against the wall and has a lot of conviction that, look, rationally, I understand that shale is the source rock for all the conventional formations. I have done the work or the experiment to confirm that shale is in fact loaded with natural gas, at least this particular shale, the Barnett Shale that we're sitting on top of. And I'm going to keep pushing because there's got to be a way for us to figure out technologically how to unlock that gas and make it flow so that we can produce it. And that story of like, I'm going to figure this out because I know that it should be able to be done. I know it can be done, or I'm going to die trying, is common across big inflection points of, major discoveries in history, but it is also very uncommon in the majority of the population. Like, most people are not wired that way. Most people are not going to obsess and think about that one thing and keep at it for 2 decades of failure before you end up, finding the right unlock for the thing that you're trying to solve.
When I think about where would I have liked to have been a fly on the wall the most in this story, when Nick Steinsberger went into the meeting where he said, let's do more of these slick water frac. At the time, the response of the executive team that he's presenting to was, "Hey Nick, shale is like largely clay. So if you put only water on clay, it sort of gums up and doesn't, you can't do anything with it." And I have no idea what he could have possibly said to get around that.
Right.
Right.
Yeah.
The reality was that I think that nobody was like, shale was not a thing generally, and they were probably referring to the samples the government had produced, and there being clay. And not only was shale was so far down the list, but the government actually, like, in all that experimentation and core sampling, they hadn't done anything in the Barnett, so
Right.
nobody knew what the Barnett Shale
Yeah,
was.
yeah. Because the clay concentration in the Barnett ends up being a lot lower, and so
Right.
that statement doesn't even apply to the Barnett. And the people that are speaking in that meeting are experts, but nobody has done the experiment in the Barnett. And so you're saying it. I think this is true of a lot of stories of major breakthroughs, is that there's an element of expertise, of extrapolated expertise, that is very arrogant, and it's not confidence from expertise, but it's arrogance because you actually don't have expertise on that particular thing. And until you experiment and sort of actually do the test, you don't really know, right? So if you're capital constrained, or if you can't afford the test, or for whatever reason it's, there's a rational decision to make that you shouldn't do the test, then maybe that's one thing. But if you can do it, if it's critical to the thing that you're trying to solve, go run the test, right? Stop arguing about it, right?
Right. Especially in this setup, right, where one important piece of the story here was that until the late 90s, the Barnett was R&D
Yep.
for Mitchell Energy, right? Like, they were only spending like 2 to 10% of capex, on the Barnett. So they were diversified. They had this real estate play at the same time. I think they ended up spending like 250 to 300 million bucks on the Barnett over like a 20-year period trying to make it work.
Yep.
But in any one year, it was R&D. They
Yeah.
weren't risking the whole company.
That's true. Although arguably, right, because of the focus and the resources, and even that amount of capital was substantial given how up against the wall their balance sheet was at times. I think the top quartile CEO of a company is probably going to make a different decision. Is probably going to kill that project. Basically, what Chevron did. I mean, I think most people would have in that seat killed the project, and I think it takes somebody with the wiring of a George Mitchell, who at his core, we didn't talk a lot about the Woodlands, but at his core, he's a visionary, right? Like, he's a guy that he is in business to have an impact in the world. And yes, money is fine, but he also came from a background of no money. And so to him, it's like, you can make money. If you run out of money, you can make money again, right? And if we go back to a lifestyle where we have to go back, fine. But he really was intent on, how do we do good? How do we change the world? Which is actually the mentality of, like, maybe today we associate with tech founders and tech startups, but it's kind of universally true for anybody who does anything, substantial, whether you're talking about John D. Rockefeller back in the early oil days, or you're talking about, Steve Jobs, in the computer industry. One more thing, Matt, that I think we should say in terms of lessons learned, and we learned a little bit of this through the .com series, is that the government usually has some role to play on the basic research part of all of this stuff. Like, government investment in basic science and basic research typically has a very long arc to generating returns, but it does matter. Sometimes the government is the only entity that will fund something that is completely speculative, basic research. It's a decades-long potential moonshot at making something massive. And so that's important because that plays a role here too.
Yeah, absolutely. Yeah, the way the government encouraged and nudged companies to go look for and produce oil and gas in the 70s and 80s with different policies is a huge part of what plays out here. Totally agree. One of my big takeaways as well, the importance of these take or pay contracts that get set up, as things are forming, right? So you had this massive natural gas pipeline build out after World War II. Mitchell Energy signs this, highly advantageous contract to them as long as they can produce enough to get it to fill the contract. If they can't produce enough, then they're on the hook to buy that gas somewhere else with their own money and get it into the pipe.
Yep.
Which signed at the wrong time by the wrong company, we'll learn later in the Shale Revolution puts a lot of companies out of business.
Yeah, we'll blow you up.
And so these infrastructure build outs and the way these contracts get signed and who they're to the benefit of and different outcomes, to me, it's like the main story
Yeah.
for Mitchell Energy. Not only that, but the fact that the buyout of the contract in the mid 90s, that's huge. And it's right before the slickwater experiments, just a couple of years before. And so the thread you can pull through this whole story of the primacy of early industry development, contracts that get signed, it's huge, and we're going through that right now with AI and data center and natural gas stuff. The foundation of the industry is being set by, and like what it's going to look like in 20 years is going to be largely determined by the terms or lack of terms of these contracts that are being signed right now.
That's right. Yep. And I think what's going to be really interesting as a sort of segue into part 2 of the series, where we're going to meet a guy who took this across the entire gas market, Aubrey McClendon, and we're going to see what happens when you mix technology with high yield debt and some of these interesting infrastructure contracts and Wall Street's appetite for growth. So it's going to be an explosive episode. It's going to be hopefully a lot of fun. Shall we leave it there for this one?
Yes, sir.
All right. Thanks, everybody. If you enjoyed this, the best way to help us is to share this with anyone that you think might like it, and to leave us a 5-star review on Spotify or Apple Podcasts, and of course, to tune in for part 2 of the Shale Revolution series next week. Thanks, everybody.
Thank you.